good afternoon, good morning, good evening, depending on the time zone you're in or when you watch. Thank you all for coming to our panel discussion titled Navigating the Biopharma Depression, More Pain or 2023 Gain. Very provocative. On the heels of the publication of Locust Walk's 2022 third quarter report on global trends in biopharma transactions, we are joined by a wonderful moderator, definitely a big upgrade from the past, and a great panel of experts to help us unpack the current trends in the industry. We have 1 hour allotted for the panel, including questions that we have prepared in advance, as well as questions received from participants. If you have any questions that you would like the panelists to address, please submit them through the Q&A system, and Rowan will read out the most frequently asked questions and ones that have the broadest applicability to the audience, interspersed or at the end at her choice. If we do not have time to address your question, we'll follow up separately with our thoughts. We'll be recording this session, and a playback on YouTube will be available shortly afterwards for attendees. I'm also obliged to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company unless the panelists specifically want to do so. And this is also not considered any legal advice or the offer to buy or sell any security. Everything discussed is also considered off the record. So, in summary, each quarter, as I mentioned, we compile these statistics, and we are in what we would characterize as a narrow depression. It's narrow rather than deep, which I would say is a long duration because of the relatively short time period that we've encountered so far, but we are certainly in the midst of something material. Private financings are down 80% in number, not value, from the third quarter of last year to the third quarter of this year. The XBI is off more than 40% in the last 12 months and more than 50% from its highs in February of 2021. IPOs are down 95% from third quarter last year to the third quarter of this year and 90% year to date. It also sounds very intimidating because we only had one IPO in the third quarter, so that's how you get to 95%. While there is still capital available, there is not enough capital to support the number of companies that were financed during the COVID boom. Unfortunately, we predict these conditions will persist well into 2023, barring an unforeseen change in Fed policy. So, not to be only gloom and doom, if we're going to gain confidence to get to the other side, three things we believe need to occur. One, fewer companies must trade below cash. Right now, there's more than 200, and we have to reduce that to no more than 50, which is still double the pre-pandemic average. Two, the small company universe must contract from the 2021 apex by at least 50 public companies selling, merging, or unfortunately going out of business. And I think we're less than halfway there. And third, the U.S. Federal Reserve, for better or worse, would need to stop raising interest rates, hopefully getting inflation under control or injecting more liquidity into the system. So I get the easy job of setting it up, and now the panelists get the fun job of actually defending or refuting that. So during this webinar, we're going to discuss these trends and more, and we'll leave it to them as the experts. I'll introduce Rowan, and then she'll take it away from here. So Rowan, thank you for joining us as the moderator. Rowan Walworth is the life science reporter at the Boston Business Journal. Those of you in the Boston area, you probably know who she is. For those of you who are not in the Boston area, you should meet Rowan. She reports in the biotech, pharmaceutical, and medical device industries in Massachusetts. She was previously the associate editor of Boston Inno and Rhode Island Inno, where she covered startups, tech, and innovation in New England. Welcome, Rowan, and the floor is yours.
Fantastic. Thank you so much, Jeff, for having me. Really excited to get into all of the sort of macro and micro trends and try to make some predictions for 2023. And of course, none of us has a crystal ball, but at the same time, we're trying to gaze into one right now. So I'm very excited to get into our questions. Again, a reminder, all audience members are free to submit their questions, and I will try to sort of sprinkle them throughout. So we can have a really robust, lively discussion. This is a conversation, this is just you watching us. We want to have a back and forth, and we want to have some actionable takeaways for company leaders. Great. Well, why don't we go around and have each of the panelists introduce themselves? Neil, why don't you start?
Sure. Great, Rowan. Thank you very much, and good afternoon, everyone. Neil Higgins, I'm a managing director here at Locust Walk. I work with Jeff and our great team here at Locust Walk. As you know, Locust Walk is a global life sciences investment bank, and we thankfully get a chance to work with many of the companies that that we're going to be speaking about today in terms of the ecosystem. Before Locust Walk, I've been here about 3 years. I was at various positions at several investment banks, including 12 years at Jefferies. And prior to that, I was a corporate attorney, but have worked in many ways for over the last 20 years, helping companies, both public and private, in the biotech space raise capital. So happy to be here and looking forward to the discussion.
Thanks so much, Neil. Amy?
Great. My name is Amy Liu. I'm an investor here at Mubadala Capital and happy to share a bit more about Mubadala Capital on the venture side a little bit later. And prior to joining Mubadala, I was at Bridge Bio for a couple of years working across various corp dev, M&A, and BD functions, and did some equity research at Evercore ISI, covering small and mid-cap biotech companies, and some clinical research before that, and have a background in biochemistry. Excited to be part of this panel.
Fantastic. Thanks.
Yeah.
Philippe, last but not least.
Yes, Philippe Lopez Fernandez. I'm the Chief Business Officer and member of the Executive Committee of Ipsen. Ipsen is a global biopharma. We call ourselves a boutique pharma. We have 3 billion of revenue. 35% of our business is in North America, 1/3 in Europe, and the rest in other countries around the world, including China and Japan. We are focused on oncology, which represent about 2 billion of our revenue, rare disease and neuroscience.
Fantastic. Well, thank you all so much for joining us. So I want to start with kind of a retrospective before we do that crystal ball gazing that I mentioned. So this year looked quite different from 2020 and 2021. Everyone was expecting this to be a large M&A year, for instance, and that kind of didn't end up being the case. IPOs were really, really slow. Analysts who predicted that they would go up in the second half of the year were wrong ultimately. And of course, we still have a couple of months left, but we're really running out of time. So what are your takeaways from what this year has looked like? How did it meet or not meet expectations? Neil, why don't you kick us off?
Happy to, and I think in a lot of ways it has not met expectations of just about everyone, as you mentioned, Rowan. And I think one of the biggest items, the elephant in the room, is the Fed. And as much as we spent most of our time in our industry focusing on the micro different items driving our sector, the Fed, and particularly how aggressive the Fed has been recently, has really put a dent in expectations. And I think that's really important for us as we look into next year in terms of what an expected recovery could look like. At the end of the day, my view is that the Fed has been aggressive for the right reasons, but at some point the Fed is going to stop. And the biotech market in particular, and I'm thinking the public markets right now, will start to anticipate that well before that happens. And the biotech sector is considered one of the top innovative growth sectors, and I expect it will be one of the leading sectors coming out of this downturn. So I'm a little bit maybe more optimistic than our Q3 headline for this call is, but I do think that's really what's driving a lot of it. There's other things that I'm sure that Amy and Philippe can speak to, but the Fed has been without a doubt the biggest driver of the downturn, I think, in the market and the downturn in expectations.
Definitely agree with what Neil mentioned there. I would also maybe like to mention that, I feel like we may have expected from the VC perspective a little bit more M&A given how depressed valuations are for a lot of public companies. And thus far, I think we've seen some good M&A, obviously with AbbVie and DJS, Eli Lilly and IPOs. I think there's been some good traction, but I think given pharma firepower and sort of where biotech valuations are, we may have perhaps expected, to see a little bit more there.
Yeah, I think it's an interesting situation because everybody is expecting much more M&A, and there's been M&A actually. Now it's not been a landslide of M&A, and I think the rationale is quite clear. We are not trying to hunt for bargains. We're trying to hunt for deals that make sense, and finding the deal that makes sense is still taking time. It involves making sure that you have the right due diligence, that you select the right one, that you have the right discussions with the companies. And frankly, there's been also there's a variety of companies that are in different situations, even with the depressed share price. Some are in very difficult situations and they don't have the means to survive in if this situation carries over in the next 6 months. That being said, if they don't have these means, it's probably very often it means that there's an issue. The others are well funded and could carry over, and they're saying why sell at this price? Why not hold and weather the storm and see what at the other end of it before I do something. And others are a little bit in the middle, but they have still expectations saying, well, 6 months ago my share price was here, so why should I do something on the share price as it is now? And it's so there's a number of discussions that are not necessarily easy. At the end of the day, I think the big message is, all the pharma companies are not trying to buy something just because it's cheap.
Mm-hmm. Absolutely. And on that note, even the companies that are doing well are trying to figure out ways to raise additional non-dilutive capital. How can they get investors' attention and best position themselves?
I'll take a first shot at that one, Rowan. So it's a really good question because there's always a level of BD activity, across the biotech space. But in particular, given the financing environment, it's become very, very difficult for companies to raise capital. There's been a lot more companies, and we've seen this in our practice, looking for non-dilutive sources of capital to extend the runway through a particular value inflection point. Because of that, to some extent, there's been a lot more activity. We think that's good, but that's also, I think, put a lot of pressure on the BD teams at the likely target companies to sift through all of the available or potentially available assets. So that is something that takes time. That also, just from a supply-demand perspective, suggests that they can be a little bit more picky. So for companies that are in that situation, we think it makes sense to really focus on the likely potential partners and to make sure they really curate that list, because they need to make sure that their message is directed to the right target that is looking for that type of asset. Otherwise, it could get lost in the shuffle. So having a very curated, thoughtful list of companies that would be partner potential, I think, is step number one. And then making sure you've got your materials properly prepared to get across to them the value of your particular program to rise that above all the others that are being floated around.
Amy, since you're also sort of looking at this from an investor perspective, I wonder if you have any additional insights here.
Yeah, so just want to give a quick background for those who aren't familiar with us on Mubadala. So we're a global venture capital platform investing in early stage companies that are transforming industries, and we're also the venture capital arm of Mubadala Investment Company, sovereign wealth fund managing over $280 billion in assets. So for us, our vision is to be a science-focused, top-performing investment platform that builds and invests in disruptive healthcare and biotech companies that are positively impacting people's lives. So I would say at the forefront, we're still pretty active, I would say. And, as we continue to see companies, I would say we continue to anchor our decisions based on the fundamentals of sort of the science that the team is developing and the founding teams. But that said, in light of the current macro environment, I would say, a couple areas that, how we've, I guess, thought about companies that has evolved sort of over the current time is there are some companies, I would say, that had raised during sort of the peak of COVID and sort of that 2021 timeframe where valuations may have been a little bit higher. And for us, I think given the current environment, a key focus is sort of on that entry valuation. So for companies that are out there, I think having some flexibility and recognizing that the valuations they may have raised at in the past may not be reflective of what's possible in the current environment, and having some flexibility there, I think, is very important. And I think the other consideration that I would mention is, for companies that are looking to raise, I would really think about, what's the minimum raise that will enable sort of the first 2 or so programs to really progress to a significant value inflection point, but also think about, if you raise beyond that, what does that enable? For example, for an extra 25 million, for an extra 50 million, where does that get you? And help to present those scenarios to investors to really showcase, this is the minimum that we need, but, if we were to raise an extra X amount, this is where we would get to.
Now, I want to take kind of a long view of how today's economic conditions might affect the biotech economy down the line. So right now, the most successful companies are the ones that have been able to secure that capital, or that had a decent cash runway before this year and are able to kind of hold the line. So as investment in earlier stage, perhaps more ambitious or out there research dries up a little bit, what are the long-term impacts that this might have if we're looking out to 2030 or beyond?
I can take that. I think we see a correction that is that is definitely favorable for a company like mine, which is in buying mode. But we don't want that correction to be too long and too sharp, because we need a healthy biotech environment. And we need to make sure that there's going to be investments, in biotech. This is really important. And even if you think about the consequences in the midterm, there's a lot of companies that have interesting science, interesting innovation, that are right now putting some of the project on hold because they want to conserve cash. And this project could be really interesting. It just, they just want to make sure that they're not going to put themselves in a bad situation, and therefore they're probably focusing on their lead or first 2 projects versus the rest of their pipeline. What are the consequences for patients of these projects that are on hold that could have reached the market earlier? We'll see. If it's just a few months, it's not going to be too dramatic. Although, tell that to patients that are waiting. It's always, a few months is always very important. If it's more than a few months, it's going to have a profound effect of innovation, and that's definitely not something that any of us want.
Rowan, I think that's a great question. I'm confident that there is enough capital out there to fund the innovative technologies in biotech that are emerging. And in fact, we're seeing a lot more focus on early stage, company creation financings, as well as some later stage ones where investors are looking to take more of a de-risked approach. But I would be more worried about 2030 if there wasn't significant capital available for early stage investments. It's quite the contrary. We're at the highest level we've seen. There's a ton of dry powder. I think what we're seeing right now, and it's to Philippe's point, we're seeing a bit of a pause, and that pause is driven by just the recent, the recent trends in biotech investing. And for those who've been through several cycles, we were at the top of a cycle, and there were a lot of companies that were being financed and going public at earlier stages than at any other time since really the biotech industry started. And that and at valuations that we're probably expecting that current trend to continue, and it hasn't. So I think the good news is we've got a lot of capital out there, and as I talk to investors, some are saying this is the best environment we've been in quite some time because of the technological advancement. They now can put that capital to work. There is a little bit of pause right now because of the public market. It's challenging to understand exactly what valuation is. And I say that understanding in the sense that both the companies and the investors may have very different views of what the valuation for a particular early stage investment should look like. But that will clear at some point. And the more that we get some stability in the public market for biotech, the more comps will be available at a sort of a normalized state for that valuation discussion to be anchored so that new investment can take place. So if we were in a situation where we didn't have significant capital available, I would be concerned. But I think this is going to turn out to be just a blip in time for the biotech investment and innovation cycle.
Maybe the only comment I would add is I think echoing sort of what Philippe and Neil mentioned, there's definitely a lot of capital to go around. But for some companies, I think there'll definitely need to be a prioritization of the pipeline. But what I think I've also seen more recently is there are sort of new business models that are emerging that in the rise of sort of this landscape, which can be interesting. There are some companies, aggregating sort of single asset companies, much like my old company, Bridge Bio, and trying to create sort of a hub and spoke model in terms of, I would say, company structure to sort of finance some of these individual assets that could not, I guess, get financed individually to the same extent. And I think also there's been more for companies that have a couple of early stage pipeline programs that may not be, I would say, core, or they have a second platform that isn't, I would say, that is sort of orthogonal to the first platform. There is interest in sort of spinning these off and creating them, I guess, creating a new company sort of focused on these platforms that can be independently financed and have a separate team and be laser focused on sort of that individual pipeline or set of programs. So I think that's something that's happening in this environment that could be a small boost, I would say, for the sector.
Great, thank you so much. We have a couple of audience questions that I want to be sure to start sprinkling in here. And again, feel free to keep them coming. The first is kind of interesting. Sophie Chow asks, if the Ukraine-Russia war continues and US-China relationship continues to deteriorate, will anything else help at all?
I'll take that. I love to think macro, even though we spend most of our days micro. I think there's a lot loaded into that question. I think part of it is we've got a pretty tough situation right now with what's happening in Russia and the Ukraine and Europe in general. Might even loop the UK into that, given what's going on politically there right now. Same with the US and China relations are at sort of a tough spot as well. And the whole concerns about what's going to happen with Taiwan. So we often go through these cycles of international concerns and at times crises. I think it's tough for us to always see through that crisis that there's another side to that, and that there's a chance for us to look through the negative and see what's on the other side on the positive side. But I do think that this is a case where that can happen. I don't think any of those things are, as much as we all worry about how they may play out, I don't think any of them are as existential as maybe the news is making them out to be. This is my view, but I think against that backdrop, the news is likely only going to get a little bit better on those fronts going forward, considering how extreme they are now. And from looking at it from an investment perspective, like Amy's and the public market investors would look at, you want to be investing when there's extreme concern, like there is now, with the idea that there's likely to be some relief to that going forward. So I'm known as being the born optimist here at Locust Walk, but that's the way I look at it.
Well, we like optimism, definitely. So let's keep it going. I think it's a tough question because right now it's people are saying was the what happens in 2020 2021 in the biotech bubble, and it's was it a bit of a hit? Yeah, but it's not like there was fundamentals that were very detrimental to biotech, and the extent of which of the reaction on the biotech market is way beyond the negative news that was out there in some companies. That being said, in times of uncertainties and with the Ukraine and the China, etc., people get rid of the things that they understand less. And there's probably a lot of investors that had invested in biotech without really understanding what it meant to be an investor in biotech, and therefore they probably got rid pretty quickly about that. And it's difficult to foresee if all of them are gone, or if it's and now the ones that are still holding biotech stocks are people that know biotech and are better equipped to understand the ups and downs. And then maybe we've seen a bottom of the biotech situation, or if there's still a lot of people that are going to get rid of it if things continue with the Ukraine situation and other things.
Well, and I imagine, I'm sorry, Neil, please go ahead.
Oh, I'm sorry. I just want to addendum to that. I think, from a practical standpoint, for companies that are trying to plan for this unknown and given the current situation, I think and Amy sort of touched on this, there's a real need to think strategically beyond just the next 6 to 12 months. So in a lot of cases, companies are doing their best to get that 2 years or more of capital on their balance sheet so that they can sort of ride out this current period. And there's several different ways besides their typical financing where you can try to do that. So I think one of the things we'd love to speak to our clients about is, in a current environment like this, how are you going to get to those next value inflection points and beyond so that you can take advantage of them? And that's what I think is really important as you think about what are the steps that companies can take, both non-dilutive and let's be honest, dilutive in some instances, in order to make it across this unknown period.
Absolutely. And on the subject of that unknown period, I was going to say that I imagine it can be difficult to pinpoint the root cause of some of the uncertainty that we've seen in the public markets. I mean, when the XBI bottomed out earlier this summer, we were seeing inflation domestically and internationally. We were seeing rising interest rates. Of course, the Russia-Ukraine war was one component of all of this, but there was a lot of other stuff going on as well. And in biotech specifically, you had all of these investors who were really generalist investors who became interested in the sector in 2020 and 2021, largely because of the pandemic and COVID vaccines and treatments, began to pull out because they realized, oh, hey, biotech is actually a pretty risky endeavor with a lot of drug failures. And I just wonder if there is any way to kind of pinpoint not only what is the cause of our current environment, but also how to plan around it.
Yeah, difficult to answer. I think there's multiple causes. There's definitely investors that have played with biotech stock in the past. Between 2017 and 2021, where everything was going up, so basically you could not go really wrong. There's also a lot of biotech CEOs that were new to biotech and that had only experienced the biotech time at the time where basically money grew on tree, and they suddenly they're facing a different situation, and it's tough, and it's probably easier when you have you're still private and you have a board of seasoned people that are really there, can help you and can work with you on addressing this difficult situation. It's more difficult when you're a public company and you've never done that. So I don't know. I mean, Amy, do you see similar things?
Yeah, definitely. I think, obviously there was a swath of capital infused and some companies during that period. I would say, in quote unquote, I wouldn't say normal times, but in times where there isn't money growing on trees, may not have stood as well independently. So I think some of these companies are sort of still finding their footing, and there may be some consolidation to really, but given I would say a general shortage of high quality talent, so some of these companies may consolidate. So then you really get the level of leadership you may need sort of to have these companies be an independent standalone entity. And I think also it's since last year, there's been a couple of, I would say, hits in the sort of the general biotech ecosystem. A lot of people obviously thought Aduhelm would have been a lot more successful. So I think there was some negative sentiment there. But I think more recently, as more good news sort of hits the biotech ecosystem, hopefully that will get some more generalists a little bit more excited about the sector in general. I mean, we saw lecanemab, the first therapy to sort of really show a stat sig benefit in Alzheimer's in a phase 3 trial, where Prime Medicine had a fairly successful, I would say, IPO and being able to raise 175 million, still as a preclinical stage company, which I think is a good sign for some of those earlier stage companies. And then we're seeing a couple more acquisitions as well. So hopefully, as more good news flow rolls into the sector, we'll be able to bring back some investors that may have, not stuck around when some bad news hit.
Mm-hmm. And on that note, what are the indications that the market might be on the upswing?
So I'll start with that one, and I think Amy hit on it. One of the things we want to see is when we see positive data that the stocks, public stocks, react positively. And I think we've started to see that this week, notwithstanding. But I think that's one of the things that we'll see. We're also seeing a real pickup in capital being deployed into the public market via pipes. And that is, I think, a bet by investors that these particular companies are going to survive and be winners. And I think the reaction to those investments has, for the most part, been very good. Those are the beginnings of the turn. Jeff mentioned up front, from our report, and it's available for anyone. Over 200 companies trade below their enterprise value is below cash on their balance sheet, and that is an implicit bet against the company spending that capital for to generate value more than the enterprise value. I think what we are starting to see with a little bit of M&A and some consolidation, that number needs to go down, and that will, over time, as we get more capital that might come in via pipes or secondaries, there should be sort of a separation of the companies that are going to make it. And unfortunately, many of those companies won't be able to make it, but that will set up for, I think, a very healthy then recovery in the market. The other part of that that's really interesting, when you talk to investors with respect to private companies, there's a sizable number of investors sort of in the crossover and asset management group who have sleeves that they can invest in the private side, and they have historically. But in the current environment, those hedge and asset managers and crossovers are looking, to the extent they can, to invest in the public market. They get liquidity, and clearly, if they believe in the underlying assets, very attractive prices for deploying that capital. And that has been, I think, a little bit of a drag on the private markets, and why we've seen, more capital on the private side has been for earlier stage biotechs, where that is very traditional venture early stage money. But the money that could go either public or private has been, for the most part, going into the public market. So when that starts to even or sort of come back to that capital going into the private market, I think that becomes, that much more helpful for the companies that are looking for capital in the private market.
And I would sort of just follow on to what Neil said. It's definitely a dynamic that we're seeing. It's really, I would say, companies that are in that sort of BC stage that are having, I would say, a slightly tougher time fundraising. It hasn't hit the A's or the seeds as much, but I think it's really for those, companies that perhaps would have, IPO'd this year or next year, and now that window is sort of closed, public, I would say, crossover investors have sort of a decision to make. They could invest in a public company with a clinical readout in the next 3 months, and if it all works out, relatively quick exit. Or if they invest in sort of one of these later stage private rounds, they may have to lock up their capital for the next year or two without a clear sense of when that IPO window will reopen. So it's definitely a challenging dynamic there. But I do think also good companies with strong fundamentals are still getting funded. So I don't want to say all hope is lost there, but I think if the team is there, the science is there, and it's a reasonable valuation, those companies are still getting the proper funds needed and the proper capitalization needed to reach their value inflection point.
Yeah, I totally agree. There's still a lot of money. There's still very good science. The good companies, the companies that have the right approach, are going to find the financing, and whether it's from the markets or from private financing or from pharma, the financing should be available.
Great. On the M&A front, we have an audience question. Bernard Fallon asks, what signs of a bottom in valuations or other flag would likely accelerate M&A?
Yeah, I think it's interesting because I'm not totally sure that people are not doing M&A because they are waiting for the bottom. It's a little bit what I was saying at the beginning. We're all looking at plenty of targets. Right now, there's a lot of targets that are around. We are trying to get the right targets for our companies, and it takes time. And when you look at the big pharma, they're looking at targets that can add revenues and add significant revenues, and they're going to be very attentive to these targets, making sure that they are the right one that can add the revenue. There's and most of them have also a lot of questions on or a lot of issue on targets that would add to their or dilute their P&L. And there's a lot of targets out there that have been actually pretty lax on spending and that have huge burns, and where the addition to that would be very detrimental to everyone's P&L. So everybody is a bit careful, and it's at the end of the day, it's not a rush to bargains. It's finding the right fit.
I think as well, there's and this always seems like a cop-out, but I do think it's true based on conversations I've had. There's just still a bit of a standoff on valuation, and it depends on where you want to anchor valuation. And I'm not going to argue either side of this equation just to describe it, but if you're looking back in your public company and your 52-week high is up 75% from where you are now, it's tough to take something less than that. But the market has changed. Capital availability has changed. Valuation has changed across the board. So on both public and private companies, I think that gap is narrowing so that we get a clearing price for transactions. But I'm surprised even recently some of the conversations about how far apart buyers and sellers are, and that over time, I'd be curious what Philippe thinks on this, but over time, for a lot of the companies that are the targets, time is not their friend. The pharma can wait, and unless it's a really competitive situation. So I think it makes sense to really look at it not in the rearview mirror and the value that you had, but what value you can get and generate for your shareholders, in the next 12 to 24 months. For some, it does pay to wait, because we do think there's going to be a market that recovers. But for others where they're really struggling with cash, they've got to, I think, really think hard, and the board needs to have that discussion where this may not be the value that we think makes the most sense long term, but given the alternatives we have, this may be a valuation we should be going out with.
Yeah, it's interesting. I think every situation is a special case. So if you can wait, sure, you might take the bet and say, if I don't need a partner now, and I don't have any problem waiting until 2024, why not wait? Absolutely. And maybe by the time it has recovered, maybe not, but you can take that bet. Now, there's a lot of companies that are saying, what do I do? I need to raise money in 2023, and it's going to be difficult. There's a lot of companies that have no inflection point in the next 3-4 years, and are wondering what even waiting could not be even a worse situation in 12 months. And of course, nobody has a crystal ball, so it's every situation is going to be different. Again, I don't think that on the buyer side we are trying to play the valuation game. We're not rushing to targets, but we're not also holding, doing something just because maybe in 3 months it's going to be a bit cheaper. If it makes sense, people are going to move, and we're all going to welcome a healthy discussion. There's still the question of what my 52-week high was at that point, and now I'm here. So, but I want the value of the deal to be based on that point. And unfortunately, that's not how it works. And when it's the opposite, and 6 months before you were there and now you're here, you're not going to accept a deal that takes the valuation, the low valuation, as your point. You're going to say my investors are expecting me to do a deal around the equity value of the company, the enterprise value of the company, based on the stock market. And for the buyers, we also have boards that are expecting us to take into account the value of the companies as defined by the stock market, and they are not going to say, well, let's pay a price that was the price a year ago, just because it was there a year ago. The market now is different, and we need to acknowledge the price from the market. And if the market is pricing this company at that level, that's where we should start the discussion.
Mm-hmm. Great. We have another audience question that I think fits nicely in this discussion. John Schwartz asks, what would be the leading indicator for crossover investors to pick up activity to support pre-IPO companies? Amy, maybe you can kick us off here.
Yeah, I think the leading indicator would be, a recovery in some of the public biotech company valuations. I think would obviously be helpful. I think seeing that there is a reasonable exit potential for some of these companies from their previous valuation, I would say would inspire a little bit more confidence there. So hopefully, as macro gets better, there's better biotech news, strong clinical trial readouts. Hopefully that will sort of accelerate the recovery there.
I might just add to that. I agree, Amy, and I think it doesn't take a really strong V-shaped recovery for that to happen. I think there just needs to be some stability in the public markets, and particularly in the biotech market. That will allow everyone to anchor to valuations for IPOs. Until then, it's likely to be insider-led deals that get done, and it's I think that's actually a reason for companies to always consider who their investors are, because there's investors that will support the company through the most difficult times and get them to exits. And so that's a key item for companies to consider as they're going through the fundraising process. But I do think, Amy, you're right. We need a recovery there that gives us, and that recovery can be flat, but that gives us something to anchor on in terms of valuation and comps. I would have argued that starting, in the middle of the summer, we were getting close to potentially having, a few IPOs come at the end of the year, with the recent, Fed aggressive, or the inflation numbers driving the Fed. I think everyone thinks it's clearly next year at the earliest. But I think that is the key. The public markets will be what drives the likelihood of IPO activity.
And I think, Neil, that's a great point you made about sort of the long-term capital. And I think that's something, even though companies in sort of that seed and Series A stage aren't hit, I would say, in terms of the challenges of fundraising as much as some of those later stage biotech companies, now is the time to really think about the investors you're bringing onto your cap table and whether or not they can support you if the IPO window is so closed. So just as you're building sort of the syndicate, just think carefully about which investors are both value add and can continue to support the company, ideally in those later private rounds, but also at the IPO and ideally through the public markets as well.
Great. Before we, I know we're getting a little bit close on time here and there's just so much to discuss, but I really want to find some time to talk about the Inflation Reduction Act. There are some provisions in that new legislation that specifically affect biopharma in terms of drug pricing and rebates. I would love for each of you to talk at a high level about what this means for pharma companies, whether we expect it to be kind of another downward force, or what the effect will ultimately be and how companies, again, can plan for it.
I can jump in with some thoughts. Obviously, it's like crackdown on pricing, which always makes it a little bit challenging for the industry in general. But I think some of the other aspects in terms of how they're treating sort of small molecules versus biologics, particularly for Medicare negotiations, it's going to be 9+ years for small molecules and 13+ years for biologics. You may see a shift in the types of therapies that are developed down the road, given more favorable, I would say, economics on the biologics side. We may see a growing increase in biologics developed and a decrease in small molecules, just given that it doesn't seem to be as valued as much. So that's perhaps one way that it can it'll shape sort of the general industry.
Mm-hmm.
The one thing I'd add to that, Amy, I think that's spot on. It's going to come down to the rules that are promulgated. The legislation is the legislation, and on its face, it's pretty dramatic for what the drug industry has been expecting, and more importantly, the rules that we've abided by for some time in terms of pricing. But the rules will be really important in terms of implementation. I've been a little surprised that it hasn't been as much of a part of discussions with companies and investors. And maybe it's because it's so recent, and maybe because it's still somewhat unknown because of those rules. But I think the important thing will to keep your eyes on those rules as the drafts come out before they get promulgated, because that will be definitive in terms of just what effect this will have on small molecules, biologics, and really the entire industry.
It's a difficult discussion. First, we don't know exactly how it's going to be implemented, and the extent and what could be next. Second, we feel that it's a step in the wrong direction. At the end of the day, the pharma industry is producing innovation that benefits everyone, and we have only a limited time after huge investment and huge risk to make money out of it, and then it goes generic or biosimilar. And this contribution to health, humanity of the generics and biosimilar is not valued. Other sectors can raise money, can raise prices, can enjoy unlimited price with price increases without really contributing to the health of humanity. Especially in the US, the full ecosystem with the PBMs, etc., is really nonsense, and yet the pharma industry is the easy target. We would have hoped that after the 2 years of pandemic and what the pharma industry did to save the world, frankly, there would be a bit more consideration about innovation, and that's definitely something that worries us. Unfortunately, pharma is an easy target, and there's so far everything that we've tried to address that publicly has been big pharma complaining about high prices, and we're not getting the message through really. But our prices drop after the years of exclusivity, and it's not infinite. The price of the profit of PBMs and hospitals, etc., are not dropping.
Thank you for those insights. We have a couple more audience questions. One from an anonymous attendee. What is pharma and investors' interest level on viral infection in the post-COVID time? How would you invest or facilitate transactions in this field?
Maybe I can kick it off. I think it's definitely an interesting area. We do think a lot about sort of the treatment I would say the treatment paradigm for viral infections and sort of more infectious disease in general, because I would say they're all very different, depending on whether you're going into sort of like, I would say like HIV, HPV, or more, I would say flu-like indications. So I think it's more of an indication-specific consideration in terms of what the treatment paradigm is, what the development path is, and cost of development there, versus I would say the area as a whole. But I do think the pandemic has definitely helped provide a boost to the infectious disease sector as a whole, whereas previously, many folks, I think given some of the hard times faced by particularly the antibiotic developers, may have shied away from infectious disease more generally. So I think it's definitely helped given a boost there. But I think for us, it's obviously still a very much indication-specific consideration.
I'd agree with Amy. I think it is very indication specific. There's been a lot of capital that went towards both antivirals and vaccines surrounding COVID. A lot of that technology can be directed towards other viral targets, but I think there's also some concern out there that we post-COVID, are there markets large enough for that investment into antivirals? So I do think it comes down to very, very specific, and I think investors, prior to the pandemic, many investors had just avoided the sector because there were clearly some challenges and headwinds. The pandemic changed that. The question now becomes, has it changed permanently for other viral infection programs and areas? And I think that's still TBD.
Mm-hmm. We have another anonymous question. This is about SPACs, so that's very exciting. If M&A is waiting for some period more, will the group of already funded SPACs come to some of these cash-poor companies' rescue or liquidate back to their initial SPAC investors in 2023?
I'm happy to take a first swipe at that. We've actually had some recent de-SPACing transactions after a period of almost no activity. And what I think, it's a good question because it is a vehicle for at least on paper, for capital for cash for companies to not only get a public listing, but also capital. Unfortunately, the experience has been quite the opposite, with redemption rates in the 90% range for a lot of SPACs upon de-SPAC. It really requires a pipe alongside the de-SPAC transaction. And in that instance, I'm not so sure the economics always make sense for both the company, the sponsors, and including, of course, the investors coming in. So there's been some things that have made it really, really challenging, notwithstanding some challenges on the regulatory side as well. I think the bigger issue right now for some of these SPACs is they're running out of time. Most of them are 1 year or 18 to 24 months max, and you've got to identify, and it's a long process. And because of the economics now of the SPAC are often being negotiated. So I think there's a good chance many of them will actually return the capital to SPAC to their shareholders. But there will be instances where it just makes sense. It lines up well, where the sponsors and the target company come to an agreement on the economics, and they believe there's enough of the capital and trust that'll actually convert at the time of the de-SPAC. And those I think we're starting to see some of them, but I think that's going to be more the exception rather than the rule over the course of the next 12 months.
And without commenting on SPACs, because I fully agree with what you said, Neil, there's also we've also seen some reverse merger, from companies that had, the technology and not the capital, and others that had the money, but not anymore the technology because it had failed. So there are a few avenues that are still available out there. But all these things take time.
Maybe just an add-on to that, Philippe. I think it's interesting. So we talk about a lot, about reverse mergers and sort of the traditional reverse merger where you have a company that has a failed program. They're sitting on cash, not much prospects, not typically a significant amount of cash, but enough where it would be interesting to another company. And that's a sort of a classic reverse merger. Given where some of the companies are now trading that are cash rich and enterprise value poor, and I think Amy was sort of heading this direction early with one of her comments. There's real opportunities for companies with a lot of cash and maybe don't have the public markets confidence in their programs to potentially bring in other programs that are that make sense for them to bring in, where those programs, whether they're single assets, Amy, as you mentioned, or they might be companies themselves that could deploy that capital better than and more efficiently than the company that has the cash on their balance sheet. So sort of a modified reverse merger where 1 + 1 equals maybe not 3, but 2.5 is something that a lot of people are thinking about, and we're starting to see transactions like that. Sort of a corollary to that is what Amy was saying with companies that have 3, 4, 5 programs that have a lead program they have a lot of confidence in, and they certainly have confidence in their other programs, but spinning those out and getting capital from that route into a new company that can be financed separately, and some of the capital from that financing goes to the parent company. But that's yet another way to try to monetize the assets that you have and extend your runway.
Great. Well, I know that we're very, very close to the end of time here, and I know we have to wrap up on time. But if I could ask each of you one single question. If you were speaking to a young CEO, less experienced, who has a promising startup but is a little bit worried about this economic environment, what is the one piece of advice that you would give them, in terms of being judicious with their spending while also planning for growth?
I guess from maybe I can take the first stab at this. From my perspective, I would say the pieces of advice I would give is really spend time sort of prioritizing the pipeline and figuring out, if you only had a limited amount of capital, which are the 1 or 2 programs you would sort of advance forward, and have a clear sense of what's tier 1, what's tier 2, what's tier 3, and also really think about how do you grow your team in a way where it's not like I would say 2020 or 2021 anymore. What are really the mission critical roles that you need to hire? What are things that you can bring on consultants for, so you can really optimize your burn profile?
Fantastic, thanks.
I'll just add real quick. I would suggest that they not only prioritize the pipeline, but be very clear about how much capital it's going to take to get to very meaningful value inflection points, and make sure you are flexible in your thinking and your discussions with your board and your investors about how to get there and beyond. The worst case scenario is having a great asset that you've got a great plan for, and you can't get to the finish line. And so I think it's important and imperative that they be very flexible and focus on how do we get through that value inflection point so that the company and the shareholders can receive that value as opposed to getting stranded.
And yeah, I would add on top of what Amy and Neil just said, which are definitely words of wisdom, I would add, don't look only at the financial aspects. Look at what else you can do to de-risk, accelerate, maximize through, having the right, the right help from your board, from your shareholders, from investors, from partners, because it's going to have a better effect than just taking a quick financial deal.
Fantastic. Well, thank you all so much for joining us today. I really appreciate your time sharing your insights with our audience here. Go ahead and wrap that up. and hopefully we'll see you at the next webinar.